You get your paycheck, you're excited to see that number, and then you look at what actually hits your bank account, and you think, wait, where did half of it go? If you've ever felt like your paycheck is getting eaten alive by mysterious deductions, you're not alone. Millions of Americans, especially those of us already stretching every dollar, are confused and frustrated by what comes out of our paychecks before we even see a dime. I'm Tony from Retirees Benefits, and today we're breaking down exactly where your money goes, what all those weird abbreviations mean, and most importantly, whether you're paying more than you should be. I read through the tax code and payroll regulations so you don't have to, and I'm going to make this as simple as possible. But first, let me tell you about something that's helped me manage my own money better. Here's something that might shock you. The average American worker loses about 29% of their gross pay to taxes and deductions. That means if you're making $40,000 a year, only about $28,400 actually makes it to your pocket. For someone already living paycheck to paycheck, that difference isn't just a number. It's groceries, it's rent, it's keeping the lights on. This hits everyone. But let me be real with you. It hits low-income families the hardest. If you're a single mom working 2 jobs, every dollar matters. You're not just losing money to taxes. You might be losing money to incorrect withholdings and not even know it. If you're a veteran transitioning to civilian work, the paycheck deduction system might look completely different from your military pay, and nobody explains it to you. If you're working gig jobs through DoorDash, Uber, or Instacart, you might not have any deductions taken out, which sounds great until tax time hits and you owe thousands. If you're disabled and receiving both disability benefits and working part-time, your situation gets even more complicated. And if you're unemployed but about to start a new job, understanding this now will save you from a nasty surprise on your first paycheck. Okay, let's go line by line through a typical paycheck. I'm going to explain what each deduction means and whether you can do anything about it. This is usually your biggest deduction. The federal government takes a percentage based on your income level and what you put on your W-4 form when you started your job. Here's what matters. Your W-4 determines how much gets taken out. If you claimed 0 dependents when you actually have 2 kids, you're giving the government an interest-free loan all year. You'll get it back at tax time, but in the meantime, you're broke. And let me tell you something that surprised me when I researched this. The average tax refund in 2024 was about $3,050. That sounds great, right? But think about it. That's $254 a month that could have been in your checking account all year long. That's groceries. That's a car payment. That's breathing room. The IRS has a tax withholding estimator tool online, and I'll link it below, that helps you figure out if you're having too much or too little taken out. I cannot stress enough how important this is. You'll see this as OASD on your pay stub. It stands for Old Age, Survivors, and Disability Insurance. The government takes 6.2% of your paycheck, up to $168,600 in earnings for Social Security. You cannot opt out of this. It's mandatory. The idea is that this money funds your retirement and disability benefits later. This is another 1.45% of your paycheck, no matter how much you make. This funds health care for people over 65. Again, you can't opt out. If you make over $200,000 as a single person, you pay an extra 0.9%, but most of us don't have to worry about that. Combined with Social Security, you're looking at 7.65% of every paycheck going to FICA taxes before you even get to federal or state income tax. On a $500 paycheck, that's over $38 gone immediately. Not everyone pays this. States like Texas, Florida, and Nevada don't have state income tax. But if you live in California, New York, or most other states, you'll see this deduction too. It usually ranges from 1% to 10% depending on your state and income. If your employer offers health insurance and you're enrolled, your portion of the premium comes out of your paycheck, usually pre-tax, which actually helps you a little bit. Here's something important. If your employer offers insurance but you can't afford your share of the premium, you might qualify for subsidies through the Affordable Care Act marketplace instead. Don't assume you have to take your employer's plan if it's eating up 20% of your paycheck. I've seen situations where someone is paying $200 a month for employer insurance with a $5,000 deductible, when they could get a marketplace plan for $50 a month with subsidies. Do the math on your specific situation. It matters. Also, if your income is low enough, you might qualify for Medicaid, which would cost you nothing. In states that expanded Medicaid, you can qualify making up to about $20,783 as a single person, or $35,293 for a family of 3 in 2025. If you're contributing to a 401k, this comes out pre-tax, which reduces your taxable income. That's actually good. You're paying less in federal taxes overall. But here's the hard truth. If you're struggling to pay rent, you probably can't afford to contribute to retirement right now. Asterisk, and that's okay. Your immediate needs come first. You can't retire if you're homeless. You might also see deductions for life insurance, dental or vision insurance, HSA or FSA contributions, healthcare savings accounts, wage garnishments for unpaid debts, child support, or back taxes, union dues. Tax brackets adjusted slightly for inflation in 2025. The standard deduction went up to $15,000 for single filers and $30,000 for married couples. What this means for you: if you haven't updated your W-4 since 2023 or earlier, you might be having too much taken out. Asterisk. The IRS changed the W-4 form completely in 2020, so if you filled one out before that, it's outdated. Also, some states are changing their tax laws. California, for example, is increasing its mental health services tax for high earners, but that won't affect most of us. Okay, I know this all sounds depressing, but there is good news. First, if you're low income and have kids, you likely qualify for the Earned Income Tax Credit, EITC. This can get you back $600 to $7,830 at tax time, depending on your income and how many kids you have. That's huge. For 2025, if you're a single parent with 2 kids making under $53,120, you probably qualify. Even if you don't have kids, you can still get up to $632 if you make under $18,591. A lot of people don't claim this because they don't know about it, so they're leaving money on the table. Second, the child tax credit is $2,000 per kid under 17. If you're having too much taken out all year, you could get thousands back when you file your taxes. And here's the thing, up to $1, $700 of that credit is refundable, meaning even if you don't owe taxes, you can still get that money back. Third, many people don't realize they can adjust their W-4 mid-year. If you get a big refund every year, that's your money that you could have had all along. Adjust your W-4 to have less taken out, and that money goes into your pocket each paycheck instead. Fourth, some states offer their own tax credits for low-income workers. California has the California EITC, New York has its own version, and several other states have similar programs. Check your state's tax website. You might be eligible for extra money back. Here's your action plan. Step 1. Find your last pay stub and actually look at it. Know exactly what's being taken out. Step 2. Go to the IRS Tax Withholding Estimator online, irs.gov/W4 app closing parenthesis, and see if you're having the right amount taken out. Step 3. If you need to adjust, ask your HR department for a new W-4 form. You can change it anytime. Step 4. If you see a deduction you don't recognize, ask HR or your payroll department what it is. Sometimes there are errors, and you could be owed money back. Step 5. If you're self-employed or doing gig work, set aside 25 to 30% of your income for taxes. Open a separate savings account just for this. I know it hurts, but it hurts less than owing $5,000 at tax time. For moms receiving child support, that money isn't taxable income, so don't worry about reporting it. But if you're paying child support, that comes out after taxes. It doesn't reduce your taxable income. For veterans with disability compensation, VA disability payments are tax-free, so you don't report them as income. But if you're working and receiving disability, your job doesn't know about your VA benefits, so make sure your W-4 is set up correctly for just your job income. For people on SSI or SSDI who start working, you can earn up to a certain amount before it affects your benefits. In 2025, you can earn up to $1,620 per month if you're on SSDI without losing benefits. Talk to a benefits counselor before taking a job so you know what to expect. Look, I'm not going to lie to you. Paycheck deductions are frustrating, especially when you're already struggling. It feels like the system is designed to take from people who can least afford it, but understanding what's being taken out and why, that's power. That's how you make sure you're not paying more than you have to. That's how you plan better and stress less. You work hard for your money. Every single dollar counts. So take 20 minutes this week to really look at your paycheck and make sure everything is right. If this helped you, please hit that subscribe button and turn on notifications so you don't miss our next video. We're covering how to boost your tax refund in 2025 next week. And trust me, you'll want to see that. Check out the description for links to the IRS withholding calculator, information about the EITC, and our other videos on making ends meet on a tight budget. And hey, drop a comment and let me know. What's the most confusing deduction on your paycheck? Let's figure it out together. You've got this. We're in this together. I'll see you next time.